Hello, and thank you for joining us on Get Real with Real Estate. I'm your host, Leo Pacheco, and today we're talking all about mortgages. And joining me is Trey DelGreco, a loan officer for Movement Mortgage, one of our preferred partners. With more than 5 years in the mortgage industry, Trey is now one of the top producers for Movement Mortgage. And in 2017, he was named Rookie of the Year for the Southeast region. And in 2021, he achieved President's Club honors. He currently helps homeowners and realtors in Florida, Georgia, and Alabama. So please welcome him to the show, Mr. Trey DelGreco. Welcome, Trey.
Thanks, Leo. Happy to be here with you today.
Great to have you. So I want to get straight to the point by addressing the topic that is on everyone's mind, the mortgage interest rates. Now, of course, we've seen an increase in the mortgage interest rates over the past few months. So how does that really affect the market and home buyers in particular?
That's a really good question. We definitely get the same question all the time, something we spend a lot of time educating people about. Interest rates are kind of one of those things that they do, in some cases, have a major impact on your plan to buy a home as a homeowner and a home buyer. Other times, it really doesn't make as much of a difference as people think it does. So it really just depends on the scenario. Everybody's scenario obviously is a little bit different. So we like to tailor our approach for each and every buyer. We find out what their financial goals are, what their plans are, what their aspirations are, and we take it from there. And we really kind of help them through this current market. Because at the end of the day, like, yes, rates are higher than they were a year ago, but they're much lower than they were 5 years ago or 10 years ago
Right.
or in the 80s when they were in the 20s. So
Yeah.
it's all relative. Historically, rates are still pretty low, and it's still a great time to buy because the housing market is very healthy. So the rates are only one piece of the puzzle. It's not the only piece.
Right. Well, something I like to try to educate our home buyers on and our sellers as well, because they have noticed that, we went from around 3% just in the fall of last year to where now we're at, around 6% or a little bit below that. And they start to panic a little bit thinking, are we in a bubble? Are we getting ready to have another crash like 2008?
Mhm.
And I know you guys, Movement Mortgage, started in 2008, which was around the same time the crash happened. Are we in a bubble again, or?
We are not. And just to put some context here, rates being at 2.75, 3%, we got used to that real quick, right? Like that's everybody's benchmark, or at least was for a little while. There's only one time in the history of mortgages that rates have been there, and that was last year. So do you really want to compare what a normal average rate is to the single best rate in mortgage history? Probably not. That's not a fair comparison. So that's just a little bit about how we look at the rates. And at the end of the day, as long as the monthly payment makes sense, that's really what matters. As far as your question about the bubble, I don't think we're in a bubble at all. There are so many different factors today that did not exist in 2007, 2006, leading up to the crash of 08, 09. Obviously, on the mortgage side with my job, the rules are much more strict now. There's a lot more specific guidelines that were put in place to prevent that from ever happening again. Case in point, you, Leo, you could apply for a mortgage back in 2005. You could say, I'm a podcast guy. I make $100,000 a year. And I would say, that's awesome. What's your social? Here's your loan. By the way, how many houses do you want to
Yeah.
buy? And we go with it. That was pretty much how it worked back then. And not only that, well, you could do that with one house, but you could do that with 4 and 5 houses at a time. They also had mortgage programs where you didn't really have to make a payment for 6 months, or you'd pay interest only for a little while, wait for the housing market to increase in value real quick, and then you'd sell it or refinance it. When everything hit the fan real quick, everybody was stuck holding these 5, 6, sometimes 10 houses that they could no longer afford to pay. That's why you had a lot of foreclosures happen all at one time. If you fast forward to today, homebuyers have a lot more equity in their homes. I am required to put them through a much more strict vetting process to make sure that they can actually afford the house they're buying. I have to prove with documents that they have the ability to repay this mortgage. And that's made a huge difference. Because of that, you're not going to see all the mass foreclosures like you saw back then. That's kind of the first piece of it. Now, the other piece you know a lot more about than I do is with housing inventory. So there's a lot less inventory now than there was back then. I don't know if you have any more specific stats, but I think the number that I saw was there's about 3 million fewer houses available today on the market than there were back then. And we have
Mhm.
about 12 million more families eligible to buy those houses. So got a lot fewer homes and a lot more buyers, and that's going to prevent the bubble from happening as well.
Yeah, exactly. And right now, just running some of the reports here in Florida. Now, one of the things that's interesting is Florida is still in a pretty big sellers market, and we're not seeing the shift as much from a real estate standpoint as you would in some of the other markets in other states. But Florida will start to cool down a little bit.
Mhm.
We're starting to see that just so slightly, but it's still pretty much a seller's market here in Florida. But the good thing is it is going to shift a little bit and kind of cool down a little bit, and the demand is not going to be nearly um, as high. But for all intents and purposes, it's not going to change that much from what we can tell so far. Because Florida is a hot market, and there are a lot of reasons why people are moving to Florida. One being the weather, one being the economy, one being that a lot of other companies are moving here and bringing their employees with them.
It's
So
definitely
there's a lot
hot here in a lot of different ways.
yeah, hot in a lot of different ways, weather included. So, no pun intended there. So, let's talk about the home buying process. Now, this is often the first step for the buyer and can seem very intimidating and overwhelming. Now, can you share with the audience what you say to a brand new first time home buyer who has absolutely no clue where to begin and what to prepare for? What should they do and what shouldn't they do as they go through this process?
Absolutely. So, first step that we always say, get started with me. We'll have a conversation again about their goals, their finances. What are they trying to accomplish here? What's their timeline to accomplish that goal? What are we really trying to do in buying a house here? That's having that information is so valuable for me because now I can sort of tailor a plan specific for each individual buyer. For some people, it's, yeah, you're ready. Let's go find you a house tomorrow. Other people, it's 6 months, maybe it's 2 years. Everybody's a little bit different. We're all at a different point in our journey. So, figuring out what their goal is and where they are in their journey is step number one. Step number two, we need to do the pre approval process. Some people call it a pre qualification process. I call it a pre approval process. And I do think this is the single most important step in the entire process of buying a home. If you don't do this step correctly, it's going to cause massive headaches, massive stress, and possibly a lot of money later on. So I like to slow everybody down at this step. Let's make sure we get this part right. That way, everything's so much easier and better for the client at the end of the day.
Great. So part of it is kind of counseling them through it and kind of coaching them in going through the process of getting a mortgage, which is really the first step, like you said, and getting pre-qualified or pre-approved. Now, a lot of home buyers don't know the difference. What's the difference between being pre-qualified and being pre-approved?
Yeah, so not every lender is built differently in this. There's a lot of lenders, especially lenders that are busier, that will sort of allow buyers to rush this step. Maybe that looks like, hey, Leo, again, you're a podcast owner, you make $100,000 a year, my credit score is 800. Okay, I think you're roughly qualified for a $500,000 home. Here's your pre qualification letter. Technically, at that point, you're pre qualified, but I have not done my job to make sure that you can actually get approved for the loan that you buy. You would be
Right.
surprised how often we ask these questions. I would normally be like, yeah, we have no problem doing this pre approval. Let's get the documents together just to set yourself up for success. And then we find out that there's some details that I didn't find out about. Maybe the buyer didn't know to share that with me. Maybe I asked the wrong questions or I didn't ask enough questions. If I sort of kick the can down the road and I don't identify those challenges and hurdles today, it does not serve the buyer. So my strategy has always been to sort of slow down. Let's make sure we get the whole picture here. And it's not that I'm saying you're lying to me about how much money you make. It's just about how the underwriter is going to view these documents. So if I can see these documents ahead of time and I can put my underwriter hat on for a minute and say, all right, does this work? Does this fit the story that we're putting together or does it not? And the more that I know ahead of time, the easier I can guide home buyers through the process.
hmm Well, and sometimes you have cases like even with myself where I have multiple streams of income because I have other businesses and I have other income coming in for different purposes.
Mhm.
So, with that in mind, sometimes you just don't think about it. I mean, you're thinking when you talk about how much money somebody makes, sometimes they're just thinking about their paycheck and
Yeah.
not the other income that's coming in or the money that they're spending, going out, and that can really have an impact
Yeah,
on
I
their
mean,
overall
I'd say
decision.
this process is important for all buyers. Even if you're a W-2 salary employee, I still want to verify it. I just want to double check, triple check, make sure so that we aren't surprised later on down the road. Now, like you said, if you've got rental income, self-employed income, several different jobs, or if you're a commission employee and your income changes from month to month, it's very, very important that we have all those details because yes, your W 2 may say $200,000 last year, but if you had $100,000 of expenses, you
Mhm.
maybe didn't quite make $200,000 in terms of qualifying income. Now that's a big difference, but maybe some buyer has $50,000 is what they tell me, but their income is actually $47,000. That's a
Mhm.
big difference. That could cause a lot of trouble when we do finally end up getting them under contract. Or we go the other way with it. Let's say they tell me 50 and they actually make 53. Now I've underestimated how much they can buy and they could possibly miss out on a great house that they love. So it's just
Mhm.
very important. It serves the client best if I have all the information. By the way, another good way to look at me is like a filter between the buyer and the underwriter. I'm not going to just take everything you send me and just throw it in the underwriter's face. Like I'm telling a story, I'm presenting the buyer to the underwriting department in a way that says, this is why Leo deserves this loan. Here's why he meets the guidelines, and here's how he's going to repay it. And I can only tell an effective story if I have the correct information.
Right. And in essence, we kind of do something similar from the real estate standpoint. Once you've been pre approved, then that gives us as a realtor the opportunity to go present your case and negotiate on your behalf as a home buyer
Mhm.
to the seller because we already know how much you're approved for. So often, home buyers like to come to us as real estate agents and say, I'm ready to look for a home. And the first thing we ask is, how are you going to pay for this home? And they're like, I'm going to get a loan. Have you talked to a lender? Have you talked to somebody? And
Mhm.
they're like, no, I figured we would do that once we identified the house that we're going to get. Well, the problem is it's kind of like throwing spaghetti against a wall and hoping something sticks. You don't have a set perimeter as to how much you can really afford because some people think that if they're paying $1,400 in rent, which that would be a dream at this point, um, if they were paying that amount in rent, that's how much their mortgage is going to be or that's how much they can afford. But there's a lot of factors that go into it, such as your debt to income ratio, your the loan to value that the lender provides. Can you explain the difference between those two terms or identify those two terms for the audience?
Which two terms? The
Debt to income, loan to value.
Absolutely. So debt to income is pretty simple. We take whatever your monthly liabilities are. That's the new mortgage payment you're applying for, a car loan, credit card payments, student loans, whatever shows up as a liability on your credit report. And we divide that by your gross income. That's the income before taxes. Most programs require you to be under 45. Sometimes you can go up to 50% when we do that calculation. Other programs, let's say maybe you're putting less money down, they're going to want an even lower debt to income ratio. So each of these types of qualifications, they do have their minimum standards. However, it's not as simple as, okay, you need to be under 50, we're at 49.99, boom, the loan's approved. They're all sort of interworking. So depending on how high your credit score is, we'll have more flexibility on the debt to income ratio and vice versa. So it's kind of like a Rubik's Cube. You make one change to one side, it changes all the other sides too. That's how
Right?
my job works, which is a lot
Sure.
of fun, but it's very challenging at the same time. Secondly, you mentioned loan to value. What that is, if you're buying a $500,000 home and your loan is going to be 400,000, your loan to value is 400 over 500, which is about 80%. So depending on what your loan to value is that you're applying for, that's going to dictate how low your debt to income ratio needs to be, maybe how low your credit score, how high your credit score needs to be. So they all kind of work together. At the end of the day, it's about eliminating risk, and it's certain factors and stats that we track. Certain metrics pose more risk, other metrics pose less risk. So that's really
Mhm.
what it's boiling down to, is just making sure that we have a good solid loan that is going to be repaid.
Sure. Well, thanks for defining that because a lot of times we get questions from home buyers wanting to know. They're saying my mortgage lender is asking me about what my debt to income is, or talking about my debt to income. I don't even know what that means.
Mhm.
I don't know what the loan to value means. I don't know what half of these terms that they're talking about means. So the good thing I like to explain to them is when you understand the terminology, it helps it make more sense, so they understand the process better. So you explaining that really helps.
Well, and not to further get way too far down the weeds here, but just to make it a little more complicated, the way that we calculate the debt to income ratio is different for different loan programs. So, if you
Mhm.
take student loans, for example, sometimes we can use whatever your payment is. Sometimes we can use $0 if you're in an income based repayment plan or if you've deferred that student loan later. Sometimes we can use a 0.5% of the balance. Sometimes we have to use 1%. So there's just so much that goes into it that a lot of people don't really understand. Sometimes they call and it's as simple as, hey, my debt to income ratio is this. What do I qualify for? And
Right.
there's 42 other questions we have to ask before we can effectively give them an answer.
Yeah. Now, the other thing that there is a misconception about, and a lot of home buyers don't really understand, and maybe you can share some more details with regard to this. There are typically four types of common loans that we see in the real estate industry, although there are many others. But conventional, VA, FHA, USDA are kind of the typical four that we see
Mhm.
for the most part. Um, Now, we know that there are various terms, conditions, and requirements for each, but starting with conventional, can you kind of share with our audience what a conventional loan is and how it compares to the others, and what are the requirements or the criteria that must be met in order to qualify for a conventional loan?
Definitely, definitely. So a conventional loan is typically going to be your standard, as plain as you can get type of loan. Maybe you've got a really good credit score, you've got your down payment 10, 15, 20% down. There's no like real weird nuances to your loan. That's going to be a conventional loan. Typically, the stronger buyers are always going to end up in a conventional loan because that's what that loan is built for. So if again you have a good credit score and you put less than 20% down, you're going to have a lower interest rate than on another type of loan. You're going to have lower mortgage insurance on a conventional versus another type of loan. So it's all about trying to figure out which loan program best serves your needs as the buyer.
And what do they consider the minimal credit score for a conventional loan?
So again, it's not just a hard minimum. Typically, the hard minimum is 620. However, if you're trying to do 3 or 5%, which is a lower down payment for a conventional loan, they may want to see that you've got a 680 or higher. It's going to be harder to get a loan approved with 5% down with a 630 credit score than a 20% down with a 630 credit score.
Mhm.
While 620 is sort of a base minimum, the higher the better. And so that's kind of when I say that it all kind of works together and it's all connected. That's what I mean by that is yes, 630 is higher than the minimum of 620, but what else is going on in your file that could require a higher credit score?
Right, right, exactly. Now, typically, most people today are qualifying, if they don't qualify for conventional, most of them qualify for FHA.
Mhm.
Tell us a little bit about FHA. What are the requirements for FHA?
So FHA is a government-backed program, and this loan program is really designed to be sort of a catch-all program, if you will. Maybe you have a lower credit score, but you've got plenty of income, and we know you're going to repay that loan, but your credit score indicates that you've had trouble paying other loans in the past. The FHA loan allows that additional risk on the credit score side and is still going to give you the maximum approvability versus other types of loans. Now, there's some key differences in the way that we price mortgage insurance on an FHA loan versus a conventional loan. But typically, those buyers that are in the low 600 range, they're going to get a lower monthly payment with an FHA loan than they will with a conventional, especially if they have a low down payment. So that's really what that loan program is for. Now, they also have some lower tolerances. If you've had a bankruptcy or a foreclosure in the past, a conventional loan might require you to wait 7 years, whereas an FHA loan only requires you to wait 4 years. So there's definitely some scenarios where, like, if you look at all the qualifications, this buyer is a really good, strong buyer. I would recommend a conventional, but they've got this one issue here that conventional just doesn't like. We could put them in an FHA loan and more than likely be able to move forward.
Mhm. So, what's the minimum credit score for FHA
So 620 is a
typically?
good minimum credit score for FHA. FHA will allow you to go down to 580. However, they want to see some compensating factors, is what we call them. So obviously, if you have a 595 credit score, that's represents some sort of risk, right? So they want to see that
Hmm.
you've got the full down payment, that it's your money. It's not a gift that you're borrowing from a family member, or your dad or your mom's not helping you with the down payment. They also don't want to really see any sort of late payments in your credit history, which you probably have because that's what's caused your credit score to be 595. But were they
Right.
recent late payments? Are you currently late, or were they late from 5 years ago? Um,
Now, you mentioned with regard to conventional, I know that conventional typically requires a certain minimum down payment, which is, we often say 20%. but I know that that's not totally true. Can you explain that a little bit?
Yes. So with a conventional loan, if you have 20% or more to put down, you are not required to pay what's called mortgage insurance. Some call it PMI, private mortgage insurance.
Mhm.
If you put less than 20% down, that's okay. The minimum on a conventional is 3 for first time home buyers and 5 for other home buyers. Um, but if you put less than 20% down, you will have to pay what's called private mortgage insurance. And again, going back to risk, if you're putting less money down, that's more risk in the file. So they offset that with the private mortgage insurance. Now, a little history on mortgage insurance is a lot of people think it's this bad thing. It's just banks collecting extra money, but that's actually not true. Before PMI was instituted, you could not buy a house with a conventional loan with less than 20% down. So this was introduced to allow more people to be able to afford to buy homes to help overcome that hurdle of a 20% down payment. Because a lot of people just don't have that, and that's okay. As long as the total monthly payment makes sense for you, including that private mortgage insurance, that's great. We'll get you in that loan program. Once you own 20% equity in the house, or as you said earlier, loan to value is under 80%, then that private mortgage insurance will go away. That risk is no longer there, and you don't have to pay that mortgage insurance anymore. That's a key difference with
Mhm.
FHA. Is with FHA, typically if it's for the life of the loan. That mortgage insurance never falls off. It's because
Mhm.
FHA allows for other risk and more risk than what a conventional loan will allow for.
And FHA is typically 3.5% down,
Typically,
correct?
yes. If you put 5% or 10% down, it does change the mortgage insurance a little bit. It'll change the interest rate a little bit too. However, most FHA buyers do put between 3.5% and 5% down.
And with FHA, even if you qualify for FHA to get your first time home, I mean, your first home ever, the great thing is even if you're paying that PMI, you can refinance down the road once your credit improves or your income changes or whatever as
That's
well.
absolutely right. And I've even had people refinance from an FHA to a conventional loan, keep the same interest rate, but their monthly payment still drops by a couple of $100 because they're now getting rid of that private mortgage insurance. So it's
Mhm.
definitely not a bad program. I mean, when you think about what home values do over time, it allows people to buy today, take advantage of that appreciation, build their net worth, and not have to wait until their credit score is higher, not have to wait until um, they have 20% for the down payment. They can go ahead and get started building equity in that home today.
Mhm. Yeah, I would say about 80% of our business is FHA loans
Mhm.
or FHA buyers, really.
It's a great
So let's
program.
talk.
It really is.
Yeah,
But it's
yeah,
great for what it's designed for. That's really the key is knowing what these programs are designed for. That's my job. That's not the home buyer's job. That's why they call me.
right, right. And a lot of times it's just because they don't have 20%, especially with the prices going up. That means that the more or the bigger the down payment you have to have.
Mhm. Absolutely.
So let's talk about. There's a couple of unique loan options that are available, but they have very, very specific
Mhm.
criteria, and that's the VA and the USDA. Let's talk about the VA.
Okay. So a VA home loan program is probably going to get any veteran the lowest possible cost to buy a home. They don't require a down payment. You're welcome to make a down payment if you'd like to, but it's not required. So they're only required to pay the closing costs at closing, which, by the way, that's a key thing that a lot of veterans are not taught through the VA. They hear 0% down and they think I don't owe a dime at closing. They still have to pay the closing costs. But it does
Right.
allow them to owe less money at closing. At Movement Mortgage, we've got a whole team dedicated. We call our Movement Military. We're here to serve veterans that everything they've done for us in our country. I think less than 1% of Americans volunteer for the military, and we cannot do enough to show our appreciation for them. So we absolutely love working with military veterans. We waive our underwriting fee. It's typically a flat fee of about $12.95. We waive that for military veterans. Typically, they get a lower interest rate. And obviously, because they're putting less than 20% down, you'd ask about mortgage insurance. There's never any mortgage insurance on VA loans. So it's a really, really good program for veterans. Some of the qualifications are a little more strict, though. VA is very strict on income stability, not just a history of income, but how stable is that income. They typically want to see at least 12 months of stable income in order to approve that buyer for a VA loan.
Mhm. Is there a minimum credit on credit score for VA?
So 580 is a minimum for that one. But again, with the lower, the 585, 590, they are still going to have very stable income. There's got to be good explanation for why their credit score is there. And we do have to sort of combat that with, compensating factors. Maybe they've got a lot of extra money in the bank to offset some of that risk, or they've got a really high paying, low debt to income ratio, high paying job. It's a salary. We know exactly what it is. It's very stable. They've been there for 5 years. A lot of veterans get military pension or VA disability. That is another thing that's stable because that's paid every month forever. We know what it is. It's easy to calculate. That's all stability that we can use to help offset that lower credit score. And they're always,
Right.
again, every program, the higher your credit score is, the lower your interest rate's going to be.
Now, for the veterans that are out there, sometimes we get asked the question, how long did I have to serve in order to qualify for this benefit?
It's a good question, a really good question. So if they're in the reserves, they can qualify for the VA after 6 years of active service, I think. For regular veterans, as long as they've been other than honorably discharged, we can approve them for a VA loan. That is just another qualifier versus all the other qualifiers. So they do have to check that box in addition to all the other ones. But as long as you've got good status, we have a website online. We can pull what's called your certificate of eligibility. That will tell us how long you served, what your eligibility, sometimes we call it entitlement, is for a VA loan. It tells us what VA disability you have if you're disabled. And it also tells you how much you get per month for that VA disability. So there's a lot of information we pull off of that document. If you have questions about whether or not you qualify, call me. I'm happy to walk you through it and see what we can do for you.
Yeah, it's great, and I love your guys' military program. I think it makes it very easy for veterans who are looking for this type of loan as well and taking advantage of those
Mhm.
benefits. So, so let's talk about one that we don't hear a lot about, but every once in a while it pops up, and it can be an alternative if somebody doesn't qualify for some of the other home loan products, and that's the USDA.
Mhm. So the USDA loan, sometimes we call it a RD loan. That stands for Rural Development. It's built specifically for rural areas. So downtown Orlando, you're not going to get any eligibility for a USDA loan. The point of this is the people that don't live in the heart of the city typically have lower incomes than people that do live in greater cities in America. So it's really built for those types of individuals. As far as them being strict, they have the lowest debt to income ratio limit of any program. And they also have an income limit, meaning you cannot earn more than their income limit per year. So it's kind of hard to thread that needle. You have to make enough money, but not too much, so that your debt to
Right.
income ratio is low, but also you're under the income limit. The benefits of that program, it does allow you to do 0% down. It does have mortgage insurance, but it's a lower mortgage insurance premium each month versus an FHA loan or a lot of times a conventional loan. So there's definitely some upside to it. Just like the VA 0% down, but you do still have to pay the closing costs.
Hmm. Okay. And and there's a map that we can actually go to as a realtor that helps us determine if a home is located in a USDA approved zone, which is another factor to that as
Yes, so
well.
you can look at the map, you can search a general area, you can zoom in, zoom out. You can also put in a specific address and it'll tell you, boom, USDA eligible. There are some settings on there where you can accidentally click like an old geographic restriction versus the current geographic restriction. So it is a little bit finicky. I'm happy to
Mhm.
help anybody search for a specific property though and tell them if they're doing it correctly or even search it for them.
Sure. So switching subjects a little bit, but sticking along the lines of types of loans, so to speak. Most loans can be either fixed rate or adjustable rate, which we call ARMs. Can you explain the difference between the two? Because sometimes people are confused about what is the difference between a fixed rate and an adjustable rate, and what's the pros and cons of each.
Absolutely. So we haven't seen a whole lot of adjustable rates in the last five, really 10 years. Typically, with a fixed rate, what happens is let's say we get you in at 5%. That means that rate will never change for the life of the loan. If you're in a 30-year mortgage, that rate will be 5.5% or 5% every month for the next 30 years until you either pay off the loan, sell the house, or refinance that loan. What that does is it stabilizes the portion of your monthly payment that's the principal and the interest portion. that amount, the total amount, is the same every month. So that's a benefit to it, right? Because you're not having to worry about rates changing. You're not having to worry about, if you bought a house 2 years ago at 3%, today rates are 6%, but you're still paying 3% interest rate. That's a huge benefit. Adjustable rates are a little bit different. Usually they're fixed for a short period of time, sometimes 3, 5, 7, or 10 years. And then once you hit that 10-year mark, the interest rate will change every year after that. Could be changing 6 months after that, depending on the terms that we get you in. So adjustables were used a lot back before the crash of '09 because you could get a nice low payment to start off, and you were probably going to sell the house or refinance it before the rates jumped anyway. So it didn't matter, right? But again, that
Hmm.
put a lot of people in some hot water. They were over borrowing and over leveraging themselves. Today, the adjustable rates really aren't that much lower than what a fixed rate is. A year ago, adjustable rates weren't any lower than a fixed rate. So you wouldn't take on that extra risk of your payment changing later. You just take the fixed rate, right? That's why we haven't
Right.
seen a whole lot of adjustable rates. As rates have increased, there are some scenarios where an adjustable rate makes sense today. I've quoted a few, I've closed a few. It's still a really powerful tool, but it's just that it's a tool. It's not the answer to every solution. So it could make sense, it may not. I think until rates get a little bit higher and that gap between a fixed and an adjustable rate is a little bit of a bigger gap, then we're going to start seeing a lot more adjustable rate mortgages, or ARMs, as you call them.
Hmm. And we see those typically also with on my side of the coin. We see a lot of the adjustable rate mortgages with investors when they're doing like lease with the option to purchase, that sort of thing. They're doing adjustable rates in their negotiations as well.
Yeah, it's a very high level
So
tool. You really need to understand and know what you're doing if you want to pursue that option. I would not recommend anybody just take the ARM because it's the lowest rate. I know rate's important and a lot of people
right.
want the lowest rate, but you could easily miss out on a better option because we've only focused on one piece of the puzzle. I've had people go with an adjustable rate before because it was 0.125 lower, and I'm like, oh, you have no idea what you just got yourself into. But they didn't want to hear, the pros and the cons of the two, so they made a decision. That's okay. Everybody has the right to make that decision. Ultimately, I'm here as an advisor to help you make the best decision based on what you foresee happening for yourself in the next 5, 10, 15 years.
Yeah, exactly. So, when talking about mortgages, we often lean towards the buyer because they're the ones that typically are looking for a new mortgage. But we often don't think about the seller from a mortgage standpoint because they already have an established mortgage in most cases. When we go to sell their home, it's just a matter of dealing with payoff or whatever. But the thing that we tend to forget is that a seller usually becomes a buyer because they have to find another home to move into. So, what are some of the programs or assistance that you can offer sellers who are thinking about selling?
We've got a lot of different third party programs that we partner with. At the end of the day, it's all about going back to the basics, figuring out your game plan. How much are you going to net from the sale? Are you going to use all of that as the down payment on the next house? And then once we have the numbers crunched, it's about timing. Do you need to move right from one house to the next? Do we need to time the sale and the purchase immediately? Can you buy the next house without having to sell your house? The answers to all of those questions is really going to dictate which tools and which programs we present to you as the seller and seller buyer in this case. So it's just all about figuring out what is the best financial strategy to help you sell one asset to buy a new one. And there's a lot of
Mhm.
different programs out there, a lot of different nuances, too many to get into today. There are some different programs out there that sort of allow you they'll buy the house from you so that you can get that sale and you can rent it back from whoever buys it. There's another program that will step in and actually buy the new house for you or reserve it, take it off the market. Then, whenever you sell your house, you go in and you buy the new house. Typically, when you do work with one of those programs, though, there's additional fees. There's cost, obviously, to do that. You're paying for the convenience of it. So, really, in today's market, what we're seeing is the house is going to sell. The house isn't really the house you're selling isn't really the challenge. It's finding out where you're
Right.
going to go and timing it correctly. So if you find yourself in a position where I'd like to sell my house and buy a new one, what do I do first? Call me. Let's put your game plan together now. We'll figure out all of those details. We'll answer all of those questions so that okay, I'm assuming we've sold this house. Here's how much house I can buy. Let me make sure I even really like the houses that are available for that price point. Okay, I think that's going to be a viable option. Now we'll go list with Leo. That's a good catchphrase, by the way. You should use that. Now we'll go list our home with Leo. And then, once they have a accepted contract, then we can start writing offers. You could even write an offer contingent on your home selling. That works too. And then there's some creative things Leo can do as well to help sort of balance the timing of the two. But I will say, selling and buying at the same time is very, very stressful. There's a lot going on in any one transaction. Now you have two transactions to deal with. So the more you can do on the front end to help make it easier on yourself, it's going to eliminate a lot of that stress for you.
Hmm. Absolutely. And that's what makes it such a great partnership, because what Trey does on the financing end and we do on the property end, they go hand in hand and work in tandem. And when we have a great lender like Movement Mortgage to do that piece of the puzzle for us, and we're helping the sellers find their next home and writing up their contingencies and so on and so forth, it really works well for us to have a great partnership such as Movement Mortgage, and really working together to help the client at the end of the day accomplish both and make it as stress. I don't ever say stress free, because it's never stress free, but it's stress less,
Stress less, for
and make it,
sure.
yeah, stress less in the
And,
process.
and I'll echo what you said there. I appreciate you saying that. It's so, so, so true. At the same time, though, my job is a lot easier when Leo knows what's going on. So when he and I have a relationship and we're working together for you, having that relationship means a lot. I can pick up the phone, call the phone, and call Leo, and he answers. Leo calls me, I answer. Like, you can't really waste time during the home buying process. And if you're spending 2 or 3 days chasing down the lender, chasing down the realtor, which is what happens when you don't have a relationship, that's all lost time, and it hurts nobody but the buyer or the seller in this case. So that relationship is everything.
Well, and it gets frustrating for the buyer, because they feel like they're doing all the work and trying to chase down all the leads, so to speak, or the people that are working on their behalf are saying that they're working on their behalf, and they start feeling hopeless and helpless, and it scares the crap out of them, and then they don't know what to do.
It's like when
So
you're
the good thing
planning
is,
a holiday event and you've got two family members that don't talk to each other. I've got to go update this person, then I got to
exactly.
update this person, I got to go back over here. That's what it feels like.
Yeah, and the great thing is when you have a partnership built like us, where we work together. A lot of times we're dealing with issues, we're solving problems, and you don't even know about it as a buyer, because we're working behind the scenes to make all those things come together, and you don't even know about it.
Or we're
And
preventing those problems from happening in the first place because we see them coming.
exactly, exactly. And because of our expertise and our knowledge, we kind of have the foresight to predict those things, or, coach our clients in a way that they should go to, kind of maneuver around some of those potholes, if you will, in the path.
It's
So
it's
that's
so
great.
real. You can't really explain how real it is until you've lived through it, but it is absolutely a
Yeah.
real thing.
Yeah, exactly. But the thing that we really strive to do, and I think this is why this is such a great partnership with Movement Mortgage, is we really try to help our clients as much as we can, and providing as many options as possible, but also helping to advise and coach you and walk you through the process so it is stress less.
Mhm.
And so with Movement Mortgage, one of the things I want to express to our audience is that the reason why we chose Movement Mortgage as one of our preferred partners was because of the fact that there is more than just mortgages that they focus on. And as you know, with me and with my company, we are very adamant about helping support charitable organizations
Mhm.
and doing things that help build up the community. And that's what Movement Mortgage was really founded on. So let's talk a little bit about, Trey, as we kind of wrap this up, some of the other areas that Movement is involved in some of the mission, vision, and values that you guys align with the Movement Foundation. And I know you guys are building charter schools, which
Mhm.
is right up my alley. But tell us more about the work that Movement is doing in a philanthropic way.
So you may notice I'm in a t-shirt and a hat today. Like, I cannot be prouder to wave the movement flag. They make it so much easier for me to have pride in who I'm working for and what I'm doing, because I know that obviously I'm making a difference in the lives of each one of my clients, but I'm making a difference in lives for people that I've never even met before. Movement makes that possible for me. So what we do, as you mentioned, we're so much more than mortgages. Mortgages is the first step, but that's just the beginning. We are very good at mortgages because that's what we do. That's all we are. A lot of banks have like a mortgage arm, but they also do checking accounts and savings accounts and auto loans. And it's just one piece of the pie for them. For us, mortgages is everything. That's how we make money. Now, what a lot of people don't know is we were actually the number 6 ranked mortgage company in terms of purchases last year in the nation. So, what a lot of people say is, well, how come I've never heard of Movement before? How come I don't see commercials on the internet or commercials on TV or your name on the big side of a stadium? Because that's not how we roll. We're not a publicly traded company. Our primary shareholder is our Movement Foundation. Through that foundation, we're able to channel about 41% of our profits to building schools. I've got my Movement Schools t-shirt on right now. We've built 7 of them already with the goal of building 100 over the next 10 years. We do outreach overseas. We do vision trips. We do every quarter we donate $10,000 to a charitable organization. Those are recommended by all of our loan officers out in the communities. And it's all about making a difference, not just with financial aid. Hey, here's 10 grand, have a great day, but really changing the lives of these individuals. The reason we focus on schools is because kids that are born into these situations where maybe they're born into poverty, maybe they don't have parents, they live with grandparents, maybe they have a single parent household. Sadly, the chances of them ever getting out of that situation are very, very low. They're more likely to end up staying in poverty or end up in prison than they are of getting out of that situation. So for us, it's go back to the roots. Let's give these kids a foundation. Let's love on them. Let's teach them what's possible. Teach them how to take control of their lives and climb out of those situations and really educate them. A lot of people don't ever come out of those situations because they're not educated. Hence the schools. Let's start educating them at a very young age and teach them not just to stay in line, not just to raise your hand if you have a question, but to really understand the value of believing in yourself and what you have to offer this world, because everybody has something to offer this world. And through that foundation, we help people understand what their purpose in this life is.
Hmm. That's fantastic. And I know that totally aligns with our mission, vision, and values. We're doing the exact same thing from a standpoint of giving out to charities, both locally and international charities, ones that are very much vetted. We like to know that the money that we donate is going to a worthy cause where we're not just making some CEO at the top of a nonprofit, very rich and famous, with big salaries, and only 30% of it's going to the actual benefactors that they claim to support. But we're really excited about the opportunity to work with Movement, not only from a mortgage standpoint, but also from the foundation standpoint. And we're going to be partnering in some other ways as well. I don't have that information as of yet, but we are going to be doing some things to help with the Movement Foundation as well.
Very
But
good.
I'm beyond thrilled to have you today as my guest, and I really appreciate the great work that you guys do at Movement Mortgage and the foundation. To get in touch with Trey, we have set up a special link at our website, and you can go to our website at lionscrestgroup.com/resources. Again, that's lionscrestgroup.com/resources. And Trey's face and contact information is right there on that webpage. So you can click on a link, go to his website, fill out the application, start the process to get your loan for your new home, and also reach out to Trey if you need to and ask him questions, etc. And he'll definitely be in touch with you once he receives your application. But let him know that you heard about him on the podcast, and just share with him some of the great information that, or how much you appreciate the information that he shared with us today. So we'll definitely have you on again, Trey, and get an update on the market and some more incredible services that you guys offer. But again, thank you so much for being a part of this podcast. Really appreciate it.
Thank you, Leo. Yeah, it was awesome talking to you. Obviously, you're a great mind, and I love partnering with people. Number one, know what they're doing, and number two, care about what they're doing, and they care about the people they're taking care of. You check every one of those boxes, so you're okay in my book, man. I've really enjoyed working with you and getting to know you, and really excited for what you and your schools have coming in the future. It's gonna be amazing.
Hey, I appreciate it. So again, stay tuned to this podcast. We'll have Trey back on again, and we'll see you on the next episode. Thanks for joining us right here on Get Real with Real Estate. I'm your host, Leo Pacheco, and I'll see you next time.